Imagine you're the CEO of a $150 billion company, right? And you know for an absolute fact that your best-selling product is about to legally be copied by cheaper competitors.
Yeah, that is literally the nightmare scenario for any executive.
Exactly. It's going to wipe out a third of your revenue overnight, and that is the exact nightmare Amgen faced going into this quarter.
Right, the classic patent cliff. It's brutal.
It really is. Their legacy bone health drugs fell off this massive patent cliff, and instead of crashing, their overall revenue actually went up 10%.
Which is honestly incredible when you think about the scale of those legacy drugs.
It's an insane escape act. So today we're looking at the anatomy of that perfect corporate escape act. We're doing a talk tickers edition of the deep dive.
Oh, I love the talk tickers format. We get right into the weeds.
Yeah, we're taking a dense, incredibly jargon-heavy Q2 2026 earnings call from biotech giant Amgen, that's ticker symbol AMGN, and we're distilling it.
Translating the Wall Street speak into something normal.
Exactly. A rapid-fire, data-forward analysis that is actually usable for you, the retail investor.
Yeah.
Whether you're holding the stock or just, watching the biotech space.
Right, because this is really the ultimate test of management in the pharmaceutical industry. I mean, when a highly profitable drug loses its patent protection.
That's what they call loss of exclusivity, right?
Yeah, exactly. Loss of exclusivity. When that happens, cheaper generic versions just flood the market. Or in this case, complex biologic copies, which we call biosimilars.
And those just eat the profit margins alive.
Oh, absolutely. The margins on the original drug collapse in a matter of months. I mean, for most companies, a 33% drop in a multi-billion-dollar legacy franchise would just be a death knell for the quarter.
Right. The stock would just plummet.
Yeah, it would completely tank the earnings call.
Yeah.
But the health of a company like Amgen navigating this transition, it tells us a massive amount about the underlying dynamics of the entire healthcare sector right now.
So let's pull apart the numbers, because as a Talk Tickers deep dive, we are looking for actionable intelligence. And, well, the raw data here is staggering.
It really is. The top line stuff alone is huge.
Yeah, total Q2 revenue crossed the $10 billion mark.
$10 billion. In one quarter.
Right. That is a 10% year-over-year increase on an already massive baseline. We're talking about generating $10 billion in a single 90-day period.
It's a staggering amount of cash to move around globally.
But top-line vanity metrics are only half the story, right? The non-GAAP operating margin came in at 48%.
We really need to pause on that 48% for a second.
Oh, we definitely do, because free cash flow was $3.5 billion for the quarter, too.
Right. And for the dividend investors out there tracking shareholder returns, they raised the dividend to $2.52 per share.
Which is a 6% increase from Q2 2025.
Okay, but going back to that margin figure, that requires some immediate context for anyone not deeply ingrained in corporate finance.
Please break it down, because 48% sounds high, but how high is it really?
So a 10% growth rate for a company already making $10 billion a quarter requires, coordinated execution across multiple global markets.
Right.
But an operating margin of 48% means that for every single dollar Amgen brings in, they are keeping roughly 48 cents.
Wow.
Yeah, keeping it after paying for the immediate costs of producing and selling their drugs and running their day-to-day operations.
So after making the drug, shipping it, paying the staff, they still keep almost half the revenue.
Exactly. In the world of physical goods or even, traditional technology hardware, a margin like that is almost completely unheard of.
It's basically software margins on a physical, highly regulated product.
Yeah, and it points to a company that possesses immense pricing power and just staggering operational efficiency.
I want to break down that 48% margin even further, though, because doing the math on their income statement reveals something kind of incredible.
What did you find in the math?
They didn't get this margin by slashing costs. They aren't starving their future pipeline to make the quarter look good.
Oh, right. The R&D spend.
Yes. Their non-GAAP R&D spending, the actual cash they are actively plowing into the innovation for future growth, it actually increased by 10% year over year.
That is wild. Usually when a company faces a patent cliff, the first thing they cut is research.
Exactly, but they raised it. And management also noted that their cost of sales sat at 19.6%.
Which is pretty low, all things considered.
Right, and they mentioned it was driven slightly higher by some profit sharing and royalty expenses, plus some changes in their sales mix.
Right, so they're paying out more in royalties, increasing their research spend, absorbing the impact of a massive patent cliff, and still
Still throwing off $3.5 billion in free cash flow. It sounds like trying to rebuild an airplane's engine while flying it at top speed.
That's a perfect analogy. Maintaining a 48% margin under those conditions means you must have a continuous, perfectly timed assembly line of new therapies.
High margin, patent-protected therapies, right?
Exactly. Ready to just slot in and take the place of the old ones. You're essentially swapping out the core foundational revenues of the business in real time.
Because if the new drugs don't scale fast enough, that margin compresses immediately.
Yeah, and if the old drugs fall faster than anticipated, the total revenue shrinks. It's a massive balancing act.
So that 48% margin sounds great on paper, but with those legacy bone drugs, specifically Prolia and Xgeva, plummeting 33% down to $1.1 billion for the quarter.
Right, losing a third of that revenue is a huge hit.
Yeah, so how is that margin mathematically possible? What is filling that multi-billion-dollar hole?
Well, management explicitly stated that the drop in Prolia and Xgeva was completely in line with their expectations.
Because the biosimilar competitors launched.
Exactly. They knew the cliff was coming. They weren't blindsided by this. So they prepared a highly diversified portfolio to cushion the blow.
Okay, so what exactly is doing the heavy lifting here?
The save is coming from what management categorizes as their 6 key growth drivers.
6 key drivers. Okay, and how are they performing?
Well, these 6 categories grew 26% in aggregate. And get this, they now make up nearly 70% of total product sales.
70%. So they really have officially replaced the old guard.
Completely. They aren't relying on one single lucky breakthrough to survive the loss of exclusivity. They are deploying assets across cardiovascular, oncology, rare disease.
Yeah, even their own biosimilars, right?
Yeah, exactly, to stabilize the ship. It's a really brilliant diversification strategy.
Let's pull the actual data on those 6 growth drivers because the numbers tell a pretty crazy story. Starting with the cardiovascular anchor Repatha.
Right, Repatha is huge for them.
Sales hit $953 million for the quarter. That's up 37% year over year.
Almost $1 billion in a quarter for one drug.
Yeah, and this isn't a story of simply jacking up the price on existing patients, which we see all the time in pharma. Management explicitly noted that new-to-brand prescriptions are up more than 50% in the U.S.
That is massive. The clinical narrative underneath that 50% prescription growth is, it's a fundamental shift in how doctors treat high cholesterol.
Break that down for us because cholesterol drugs have been around forever.
Right. So Repatha is a PCSK9 inhibitor. But for decades, the undisputed standard of care for high cholesterol has been statins.
Like Lipitor, right. Just a cheap, simple, daily oral pill.
Exactly. But the problem is, millions of patients worldwide simply cannot reach their LDL cholesterol goals with statins alone.
Is that because of side effects or something?
Yeah, side effects like muscle pain or just genetic predispositions where statins aren't enough. But for a long time, doctors treated Repatha as a last resort.
Because it's a biologic.
Because it's an injectable biologic, and honestly, it was expensive, so doctors were hesitant.
So how did Amgen get prescriptions up 50% if doctors were hesitant?
They spent years fighting to change that perception. They utilized these massive cardiovascular outcomes trials, like their landmark Vesalius-CV trial.
Okay, what did that trial actually prove to the doctors?
They're building the clinical case that earlier intensive LDL lowering actually prevents cardiovascular events, like heart attacks and strokes, before they even happen.
Oh, so they are shifting the standard of care from being reactive to proactive.
Exactly. You don't wait for a heart attack to prescribe the good stuff anymore.
But marketing and clinical trial data only get you so far.
True.
Marketing can convince a doctor to try a drug once, sure, but clinical efficacy is what keeps them prescribing it.
Yeah, the real world results have to match the trial data.
Right. So if we're looking for evidence of sustainable clinical adoption, we have to look at who is actually writing these prescriptions.
And that's where the primary care shift comes in, right?
Exactly. Management noted that the 50% growth in new prescriptions is split right down the middle.
Okay, so who's writing them?
Half of it is coming from cardiologists expanding their use for secondary prevention.
Meaning patients who have already had a heart attack and need to prevent a second one?
Right. But the other half is coming from primary care physicians prescribing it for high-risk primary prevention, particularly in diabetic patients.
And that is the golden ticket. When you penetrate the primary care market, you transition a drug from a niche specialist tool to a mass market foundational therapy.
Because there are just so many more primary care doctors than cardiologists?
Exactly. A cardiologist might see a patient after a catastrophic event, But a primary care doctor is managing the chronic day-to-day health of thousands of individuals.
So once primary care doctors get comfortable prescribing a biologic injection for just general cholesterol management,
the total addressable market expands exponentially. I mean, that kind of adoption creates a very, very durable revenue stream.
Okay, moving down the list of these 6 growth drivers, we have Eventity. That's their newer bone builder.
Right, essentially the replacement for Prolia.
Yeah. It brought in $714 million, which is up 38% year over year. But the geographical breakdown here is fascinating to me.
Oh yeah, the Japan numbers are wild.
They have achieved massive market penetration in Japan, capturing over 55% of the volume share.
Over half the market in Japan. But the US is totally different, right?
Completely. Meanwhile, the U.S. opportunity remains mostly untapped. They've only reached mid-single-digit penetration domestically.
It just shows how different regulatory environments and healthcare systems adopt new therapies at completely different speeds.
It really does. So following Eventity, we have Tespire for severe asthma. That pulled in $486 million, up 42%.
Tespire is a great example. It demonstrates the classical pharmaceutical strategy of maximizing an asset through label expansion.
Label expansion. So taking one drug and getting it approved for other diseases?
Exactly. When you develop a biologic that targets the underlying mechanism of inflammation, and in Tespire's case, it targets a molecule called TSLP at the very top of the inflammatory cascade.
So it stops inflammation right at the source.
Right. And when you can do that, you don't just stop at asthma. The underlying biology driving that severe asthma is often the exact same biology driving other diseases.
So what else are they testing it on?
Well, Amgen is currently testing Tespire for chronic rhinosinusitis with nasal polyps.
Oh, okay.
And they're expecting phase 3 results for eosinophilic esophagitis.
That's a mouthful. What exactly is that?
It's a chronic immune system disease of the esophagus, and it affects over 400,000 patients in the U.S. alone.
Wow, that's a huge additional market.
It is. You build a blockbuster by proving the drug is safe and effective in one indication, like asthma, and then you systematically expand its label to cover related inflammatory diseases.
Just stacking revenue streams right on top of the original clinical investment.
Exactly. It's incredibly capital efficient.
Okay, that brings us to Imdelltra. This is an innovative oncology drug for small cell lung cancer.
This one is really exciting from a scientific perspective.
The financials are exciting too. Sales were $288 million, representing a massive 115% year-over-year increase.
More than doubling year over year.
Yeah. Management sounded incredibly bullish here. And looking at the history of this specific disease, it makes sense. Small cell lung cancer has been an absolute graveyard for research and development.
It's brutal. It is an incredibly aggressive cancer, and for decades, patients were essentially stuck with standard chemotherapies that offered, honestly, very limited survival benefits.
Yeah, innovation in this specific space has been basically non-existent for years.
But Imdelltra is changing that landscape because of its mechanism of action. It's what's called a bispecific T-cell engager.
Okay, we need to translate that. To understand why that is driving 115% growth, how does a T-cell engager actually work?
So you have to look at the biology. A T-cell engager is a highly advanced engineered molecule that acts like a biological bridge.
A bridge between what and what?
One end of the molecule binds to a specific target on the surface of the cancer cell, and the other end binds to a P cell, which is basically the attack dog of the patient's own immune system.
Oh, wow. So it literally grabs the cancer cell and the immune cell and pulls them together.
Yes. It physically drags the immune system to the tumor and forces it to attack. And because of the profound survival benefits seen in trials, Amgen has already secured NCCN recommendations.
What are NCCN recommendations for the retail investors listening?
Those are the National Comprehensive Cancer Network clinical practice guidelines. They're used by oncologists across the entire country to decide standard of care.
So getting on that list is a huge deal. But administering a T-cell engager isn't like handing out a pill, right?
Oh, definitely not. It requires serious hospital infrastructure.
Because these drugs can cause severe immune reactions, right? Like cytokine release syndrome, where the immune system essentially overheats while attacking the cancer.
Exactly. The patients need to be carefully monitored, usually inpatient at first.
Right. And management stated they now have over 2,000 accounts operationally ready to use Imdelltra in the U.S.
2,000 hospital systems ready to go. That takes so much work.
Yeah. They're getting hospital clinical staff trained, updating monitoring protocols, building the infrastructure to administer this drug safely.
Right.
And you do not spend the money and time to train your clinical staff and update hospital protocols across 2,000 accounts based on marketing hype.
No, hospital administrators would laugh you out of the building.
Exactly. You do it because the clinical data proves this drug is the new standard of care for extending survival, and that creates an enormous economic moat.
The infrastructure being laid down absolutely solidifies that moat. Once a complex biologic is entrenched in the standard of care and a hospital system has built its operational workflows around it,
it becomes a habit for the hospital.
Yeah, that revenue stream becomes incredibly sticky. Competing pharmaceutical companies don't just have to prove their future drug is slightly better.
They have to convince 2,000 hospital systems to completely retrain their staff and change their protocols all over again.
Which is a massive hurdle.
Okay, rounding out the 6 growth drivers, we have their rare disease portfolio, which grew 21% to $1.6 billion.
Rare disease is always a strong high-margin category.
Yeah, and that growth was heavily driven by Plisna, up 90%, and Tepeza, up 14%.
Both very solid performers.
But here is the ironic part. While Amgen is bleeding revenue from biosimilars attacking their legacy drugs, their own biosimilars portfolio generated $855 million.
Growing 29%.
Yeah. A massive standout there was Pavblu, which was up 121%.
So they are playing both sides of the board.
Exactly. Inventing the new therapies while simultaneously manufacturing the generic biologics that are eating away at their competitors' older drugs.
It is a brilliant hedge. I mean, biologics are so incredibly complex to manufacture that the barrier to entry for creating a biosimilar is astronomically high.
Because it's not just mixing chemicals.
Right. You are essentially growing medicines in giant vats of living cells. You can't just synthesize them in a chemical lab like a standard generic pill.
So not just anyone can start making these.
Exactly. Amgen is leveraging its world-class manufacturing capabilities to capture the downside of the patent cliff across the entire industry,
turning the very mechanism that destroyed Prolia into a nearly billion-dollar growth engine for themselves.
It's honestly a masterclass in corporate strategy.
So let's recap where we are. We have double-digit revenue growth on a massive base. We have the new guard of drugs comprehensively covering the multi-billion-dollar losses of the old guard.
Right. The mid-air engine swap is actively working.
But the stock market is a forward-looking mechanism.
Yeah.
Investors aren't paying for Q2 2026. They are paying for the cash flows of 2027, 2028, and beyond.
So we need to look at management's guidance.
Yes. Moving to Section 3 here. Management officially raised their full year 2026 guidance. Revenue is now expected to land between $31.2 billion and $38.2 billion.
That is a very healthy bump.
And they are guiding for a non-GAAP earnings per share between $22.30 and $23.50.
While also stating that full-year operating margins should stabilize around 45 to 46%.
Exactly. So raising both the top-line revenue guidance and the bottom-line earnings guidance, what does that signal to you?
It is a massive signal of confidence from the C-suite. It means they aren't just selling more products by discounting them heavily to pad the revenue numbers.
They are selling them profitably.
Yes, they have enough visibility into clinical adoption rates and supply chain logistics for the remaining 2 quarters of the year to promise Wall Street a higher target.
But, the most revealing number in their forward guidance wasn't the revenue.
Oh, I know where you're going with this. The capital allocation?
Yes. The capital expenditures, or CapEx, is set at a massive $2.6 billion for 2026.
$2.6 billion. That's huge.
It is. And this money is going directly into physical infrastructure. They specifically cited that they are building state-of-the-art manufacturing sites in North Carolina, Ohio, and Puerto Rico.
Right. Expanding their manufacturing footprint heavily.
And the stated goal for these facilities is to scale capacity for volume growth, specifically calling out the upcoming launch of their obesity drug, Maritide.
In the biotech sector, a $2.6 billion CapEx figure is a monumental, highly calculated bet.
Because building these facilities isn't quick, right?
Oh, it takes years. It involves installing massive stainless steel bioreactors, constructing pristine, clean rooms, and, passing brutal FDA inspections.
You do not spend $2.6 billion on manufacturing capacity unless you are absolutely certain you have a product that requires that scale. And here's the crazy part. They're building these multi-million-dollar factories before Maritide is even fully approved by the FDA.
Which is just a massive flex.
Right. They are looking at their internal blinded phase 3 trial data, and they are so certain of the drug's efficacy and its future market dominance that they are willing to risk billions on the infrastructure to manufacture it right now.
Because if the drug fails in trials or gets blocked by the FDA, those factories become massive liability.
Exactly. So accelerating this CapEx proves they believe Maritide is a guaranteed blockbuster.
It signals absolute, uncompromising conviction. I mean, the obesity and cardiometabolic market is currently the largest, most lucrative pharmaceutical space in the world.
And it's flooded with weekly GLP-1 injectables right now from competitors.
Right. So to justify this level of capital investment, Maritide has to be significantly differentiated from the incumbent drugs that are already generating billions.
And Maritide really is the gravitational center of their future pipeline. They have 9 ongoing phase 3 trials for it right now.
9 trials. That is a huge clinical undertaking.
It is. And the chief scientific officer spent significant time on the call explaining the science of that differentiation.
The science here is what sets it apart from the weekly GLP-1s.
Right, because most current obesity drugs use peptides, which are small chains of amino acids that basically mimic the body's natural satiety hormones.
They tell your brain you're full.
Exactly. But the problem is that the human body breaks down these natural peptides very quickly. They are cleared from the bloodstream in a matter of days.
Which is exactly why patients have to inject themselves every single week to maintain the weight loss.
Right. But Amgen engineered a completely different pharmacokinetic profile. Maritide is an antibody peptide conjugate.
Let's break that down for the listeners. What does that actually mean?
They took the active peptides and chemically bonded them to a much larger monoclonal antibody backbone.
Okay, so they attached the small peptide to a huge antibody.
Exactly. And antibodies naturally have a much longer half-life in the human body. In this specific case, the molecule circulates for about 21 days before breaking down.
Wow, 21 days versus just a few days.
Yeah, the analogy I like to use is it's like attaching a heavy anchor that's the antibody to a helium balloon, which is the peptide.
Oh, I like that. So on its own, the balloon just flies away and disappears in minutes.
Right, but tethered to the anchor, it stays exactly where you put it for weeks. Because the medicine stays in the system so much longer, Maritide is designed for monthly dosing.
Which is already a huge upgrade over weekly.
But they even stated it has the potential to be dosed as infrequently as 4 to 6 times a year.
A shift from 52 injections a year down to 4 to 6 injections a year is a massive paradigm shift in patient care.
It changes the whole user experience of the drug.
Completely. The convenience factor for the patient is astronomical, but more importantly, that convenience drives clinical adherence.
Right, because the biggest flaw in the current obesity drug market is that patients just start taking the medication.
Exactly. Because of side effects, cost, or simply the fatigue of a weekly injection schedule. People just get tired of it.
But if a patient only has to visit their doctor once a quarter for a dose, the clinical outcomes improve dramatically because they aren't missing doses.
Amgen is trying to completely disrupt the administration schedule of the entire cardiometabolic market.
And they are being absolutely ruthless about protecting that high standard of convenience and efficacy.
What do you mean by ruthless?
Well, in the same breath that they praised Maritide, they casually mentioned that they killed off another internal obesity asset.
Really? Just scrapped it?
Yeah, a phase 1 drug called AMG 513, and their justification was simply that, quote, the bar is high at Amgen for obesity medicines.
Oh, wow. A lot of pharmaceutical companies will keep mediocre drugs on life support in early stage trials just to artificially inflate their pipeline numbers for investors.
Right, just to make the slide deck look better.
Exactly. So cutting a drug early because it doesn't meet a strict internal hurdle rate shows a very mature capital allocation discipline. It shows they refuse to throw good money after bad.
But, building these Maritide factories and running 9 concurrent phase 3 trials isn't their only cash drain.
They still have to keep investors happy today.
Exactly. They have to balance that $2.6 billion capex against the rest of their capital deployment. Management stated that share repurchases will not exceed $3 billion for the year.
Capping buybacks makes sense when you're investing this heavily in growth.
They also noted a $100 million upfront payment for a new business development transaction that will hit Q3 R&D expenses.
So they are actively hunting for smaller, early-stage external innovation to supplement their internal pipeline, too.
Yeah. They are balancing immediate shareholder returns through the dividend and limited buybacks with aggressive internal R&D and strategic external acquisitions.
So we've covered the headline data, we've gone through the biological mechanics of the product portfolio, and we've analyzed the aggressive forward-looking guidance.
It is time for Section 4. Time to synthesize these moving parts and deliver the final verdict.
The bottom line.
Exactly. Looking at all this data, the talk ticker's position on this quarter is definitively bullish.
Absolutely bullish. For a retail investor, analyzing this earnings call is like watching a masterclass in pharmaceutical pipeline management.
The massive financial risks associated with the patent cliff have been thoroughly mitigated, right?
The market fully anticipated the multi-billion-dollar drop in legacy drugs like Prolia and Xgeva. That decay was entirely priced into the stock months ago.
What this quarter proved is that Amgen is actively and highly profitably replacing those dying revenues with next-generation assets.
So what does this actually mean for someone holding or considering this stock?
Well, if you are holding the stock, the 6% dividend hike and the $3.5 billion in quarterly free cash flow provide a very secure, stable financial floor.
The company is just gushing cash today.
Right. But the ceiling on this stock is dictated by Maritide.
That phase 3 obesity data is the massive upside lottery ticket in a booming sector.
If Amgen successfully launches a weight loss drug that only requires a handful of injections a year, the revenue potential is truly astronomical.
As an investor, you are essentially being paid a solid, growing dividend to wait and see if they revolutionize the largest public health market in the world.
Let's recap the core actionable takeaways, concise and plain. Number 1, Amgen is delivering double-digit revenue growth on a massive base, pulling in over $10 billion a quarter while maintaining nearly 50% margins despite intense biosimilar competition.
Incredible execution on the baseline business.
Number 2, the highly diversified new guard of drugs, Repatha for cholesterol, Tespire for asthma, and Imdelltra for oncology, are scaling fast enough to completely cover the losses of the old guard.
Because the underlying biology of these new drugs is actually changing the standard of care across multiple medical disciplines.
Exactly. And number 3, the raised financial guidance and the multi-billion-dollar CapEx spend proves management's absolute confidence in the approval and future dominance of Maritide.
The underlying strategy is executing flawlessly, and the financial guardrails are firmly in place to protect the downside while investing for massive upside.
As we wrap up this deep dive, there is a final provocative thought to chew on that goes far beyond just the ticker symbol and the quarterly revenue.
Oh, I'm intrigued. What's the thought?
We've talked extensively today about dosing schedules and pharmacokinetics. Right?
Yeah, the transition to longer-lasting drugs.
Right. Repatha is being taken every 2 weeks. Their rare disease drug, Plisna, is dosed twice a year. And, of course, the potential for Maritide to be dosed just 4 times a year.
Right.
For a century, the pharmaceutical industry has trained humans to open a plastic bottle and swallow a pill every single morning. It is a deeply ingrained behavioral habit right next to brushing our teeth.
Amgen's entire strategy across multiple therapeutic areas relies on a massive shift away from that daily pill toward highly persistent, infrequent injections.
They are betting that biological engineering can overcome the human flaw of forgetting to take medication.
Because people are terrible at taking their pills every day.
Exactly. If Amgen successfully rewrites those patient adherence habits, if they convince millions of people that managing chronic disease is something you only think about 4 times a year at a doctor's office, they aren't just winning market share.
No, they are fundamentally changing how human beings interact with medicine entirely.
That is a behavioral shift with implications far beyond a single earnings report.
It's a fascinating way to look at their long-term moat.
Thank you for joining us on this Talk Tickers edition of The Deep Dive. The diagnostic landscape of corporate finance might look murky at first glance, but if you look closely at the data and the biology driving it, the picture always becomes crystal clear.
Keep your portfolios sharp.
And your insights sharper. We will catch you on the next one.